Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Hello and welcome to the latest Provident podcast. I'm Scott Davis and I'm joined by my colleague Eric Major. For today's discussion, we're going to be talking about the use of third-party debt in private equity transactions. As a reminder, Provident Healthcare Partners provides M&A advisory services to those seeking institutional capital or the assistance of a strategic partner. Many times our processes focus on those looking for their first institutional capital, and as a result, there's a fair amount of education that goes in on the front end of a process. Part of that relates to the use of this third-party debt. For today's discussion, we're bringing in a colleague of ours, Matt Evans from Monroe Capital, and I'll allow Matt to provide an introduction of his own.
Yes, hello. Thank you for having me. My name is Matt Evans. I'm a managing director at Monroe Capital. We're located in Chicago. We manage approximately $9 billion. We serve various roles within the middle market leveraged finance realm. We help to provide debt financing to private equity-backed transactions. These are M&A transactions and follow-on transactions that Provident Healthcare, as well as many others, are bringing to market. We also provide unique and flexible debt and occasionally equity solutions to other middle market companies. We are a generalist firm, but we have a couple of verticals that we specialize in. One of those is healthcare. We have a rich healthcare practice. It's approximately 18% of our overall portfolio, and thus it correlates pretty strongly with healthcare as a percentage of GDP. We've been active in healthcare for over 15 years. The subsectors that we participate in are varied. We do a lot of healthcare services businesses. We also are investors in all types of other subsectors that participate in healthcare who sell outsourced services, products, information technology, and other services and products into healthcare.
Terrific. Thanks for joining us, Matt.
Thank you.
And so for today, we were thinking just a Q&A between ourselves and Matt to give folks that are listening a feel for this use of third-party debt, how it fits into transactions, some of the common misconceptions, and a number of other topics as well. So to start, Matt, we were curious to get your thoughts on why the prevalence of third-party debt within the use of private equity investments.
So for those who don't spend a lot of time in this realm, the use of debt, there are a lot of different functions for it. Number one, if you think about acquiring any kind of an investment asset, the use of debt can provide leverage to an investor and thus enhance returns. So a really high-level example would be if you bought a piece of machinery for $100 and used $50 of debt and $50 of equity, and the value of that machine increased to $150, your equity just increased from 50 to 100, and thus you doubled, as opposed to only increasing by 50% if you didn't use debt. So from a high level, investors, private equity firms, and other strategics like to use debt to help enhance their returns. It also serves as a tool for the investor to limit their exposure or investment into an asset. So whether it's a private equity firm or strategic, their balance sheet, their funds available, their capital is finite. It's limited. And so they have to take a portfolio management approach to all their investments and have adequate capital to invest in a number of different investments. So leverage is a tool for limiting that resource. In addition, in follow-on investments, add-on acquisitions, the M&A world and leverage finance is very active in volume with add-on acquisitions. Investors like to utilize debt to the extent that they can to enhance returns and consummate these add-on acquisitions with as much debt as possible.
Yeah, and I would say one of the important factors we see with debt as well, which again takes some education with some of the sellers that we work with. Obviously, as it enhances the private equity return, it also enhances the return for the sellers as well in terms of their rollover equity.
And Matt, you used the example of 50% equity, 50% debt. How would you say that is typically structured in a real world example? Is it close to that, higher, lower? What do you typically see?
You know, it's interesting. Over the years, the structures that have been applied to various transactions, they used to differ quite a bit when you were working with a company that, let's say, had $6 million of EBITDA versus a company that had $25 million of EBITDA. But those structures have converged over the years. And so thus, we see similar ratios of debt to capital structure, debt to equity, however you want to analyze the transaction structure today in all sorts of shapes and sizes. And I would say that as a rule of thumb, you will typically see the debt be somewhere in the realm of 45% to 60% or so of the overall capital structure. And that's governed by a number of functions. Number one, as debt investors, and we like to think of ourselves as investors as well, our upside in a transaction is typically limited. It's limited to the interest that we charge. And perhaps there are some other functions that provide upside, such as warrants or equity, and that we invest as well. However, since our upside in the deal is limited, we want the risk of our capital to be lower than the risk of the equity investor. And so thus, we try to limit to what extent we lever a business according to its enterprise value. So if a company is valued at 10 times, someone is looking for 8 times EBITDA of leverage to be applied there, what I would argue, a rational debt investor will look at that and say that is too much debt as a proportion of the overall capital structure. And thus, you just don't see a lot of deals in the middle market space get structured as sort. And again, we typically see that range of debt as part of an overall structure to lie somewhere in the realm of 45 to 60%.
Great. And you alluded to the use of a capitalization table, kind of where the debt fits into a broader structure. Can you give us a feel for how those are typically laid out, where debt resides within that versus the equity, and kind of how things would play out in a liquidation?
Yeah, again, it depends. There are various securities that can exist within a transaction structure. You can have senior debt, mezzanine or subordinated debt, seller debt, preferred equity, and common equity. We have the ability and flexibility, I should say, at Monroe Capital to participate in all the different tranches of a capital structure. Although we spend most of our time in the top half of the structure, consisting of senior debt and mezzanine debt. Our offering tends to be a combination of those two and what's known in the industry as unitranche debt. But one of the perspectives that we take when trying to figure out where to draw the line in a transaction between the debt and the equity is indeed, to your point, as far as a downside scenario and what would occur there. First of all, we try to figure out what can go wrong because not everything goes right all the time. And so firstly, we try to figure out the top 2 or 3 most likely scenarios where something goes wrong. Number 2, what would be the impact to the business and thus its enterprise value if those things went wrong, one or more of them. And then lastly, how would we go about recouping and protecting our capital? And we don't like to do this, but unfortunately, once in a while, as a lender, we have to protect ourselves to the extent that we actually have to take possession of the business or take the keys, as the industry parlance goes. And so when we calculate what would be a likely turn of events, should we unfortunately have to take the keys to a business, and what the likely outcome would that be, whether it's flipping the business to another private equity firm or to a strategic, or owning and operating the business ourselves until we can stabilize the business to the extent that we can sell it and get our capital back. We try to figure out where that line would be in terms of the potential depreciation and the value of a company. And that is yet another variable that helps us determine where the appropriate amount of debt level in a business transaction should be.
Yeah, Matt, I think one of the things that always comes up with our clients as it relates to debt, obviously if they go out today independent of having a private equity partner, typically taking on debt requires personal guarantees, and there's obviously a risk tolerance associated with that. As they kind of think about this more of a doomsday type scenario, I mean, what kind of diligence are you all doing from your perspective? And, are you requiring personal guarantees from sellers in any of your transactions?
So we are not. We're, part of our differentiation, I would say, hits on this, which is not all the transactions we do are private equity-backed transactions. A lot of the businesses that we are providing capital to, they may not be yet ready to sell to a private equity firm. They feel as though they still have a lot of growth on the come over the next couple of years, and they want to prepare themselves more adequately for a private equity transaction and achieve other growth before that to enhance their value. So a lot of the businesses that we transact with have never had more formalized institutional involvement other than, let's say, a bank, their local bank. And typical structures with a community bank, they may be asset-based, they may have personal guarantees and other relationship local tie-ins to their business, such as their working capital revolver and their cash management. We approach a business as far as what its EBITDA is, what its enterprise value is, the industry that it's in, the management team that it has, what are the downside risks, et cetera. So when we structure our deals, we take a lien on the assets of the business. We take a stock pledge on the business. So technically, we would be able to enforce a stock pledge and take over a business if we needed to. However, that's not the business that we're in. That's not our modus operandi. There are firms out there that are called, you could call them loan sharks, you call them loan-to-own shops. There are more aggressive investment houses that seek to take advantage of companies to enhance their returns to their investors. That's not the way we approach the market. We want to be borrower friendly. We want to have a good reputation in the marketplace. And again, that extends beyond the private equity realm, but to intermediaries like Provident, to consultants, to lawyers. We get our deals in from a lot of different folks. We want to be known as good guys in the industry. And so while we structure our deals such that if bad things happen, we can act in order to preserve our capital, we try to take a more polished institutional approach to things and not act like a community bank. And we're not going to have the owners of businesses sign up to items such as personal guarantees or other such legal documents in our deals.
And Matt, it sounds like a lot of the work you do on the front end is to ensure that that business is able to withstand the use of this capital and that the balance sheet is in a position to do the same. What would you say are the kind of common characteristics of one that maybe isn't prepared to withstand that and the implications of being over-levered? How would that be seen and kind of play out?
So number one, and one of the first items that we look at in a business is its management team. And within that, the financial controls. So a lot of businesses that haven't yet gone through a institutional round of capital, whether debt or equity, may not have a really formal experienced CFO. They may have an outsourced accountant or more of a controller that's putting books together for the owners of the business for their taxes on an annual basis. But we really want to dig into the financials of a business, not only before we do the deal, but after we do the deal. So the first thing we look at is what are the financial controls of a business? How accurately can the business assess its P&L, its balance sheet, project what those are going to be, and report to us what those figures are on an ongoing basis. And depending on the situation, yes, oftentimes, whether it's a sponsor-backed deal or a non-sponsor-backed deal, a borrower wants to take on more debt than perhaps we view appropriate. The debt service, and by debt service, I mean the interest payments as well as any amortization payments that go along with the security, may be too much for the business to bear and may take away from the business's ability to sustain its working capital, to take the money that it needs to take and invest in the growth of the business, to maintain, let's say, the technology base that the business relies upon or machinery and equipment. So we want to make sure that even after taking into account the proposed debt service on a deal, that the company is still going to have enough free cash flow to be healthy. And when we do our calculations and we find that the business wouldn't be able to afford that free cash flow, we certainly try not to get involved in situations like that and work with the borrower to help them understand that they still need to maintain a healthy balance sheet as well as appropriately use leverage.
Yep, that all makes sense. And we've used a number of different kind of buzzwords, particularly for the different types of debt and debt instruments that are out there. I thought maybe it would make some sense to cover a few of those just to get kind of some definitions and also understanding in terms of how they compare to one another. So if you would, maybe if you could just highlight for us kind of the top handful of instruments that you all work with and potential sellers would see in the market.
Yeah, and I can start with a really high level viewpoint on this as far as what a capital structure of a business means. If you start from the bottom to the top of a capital structure, at the very bottom you have the equity or the ownership in the business. This is the capital that's the riskiest, however, has the most upside because they are the owners of the cash flow of the business. They are owners of any proceeds that would come from the sale of a business. Moving up from the equity side, you get into more of the riskier debt. And again, the definition of this debt is mezzanine debt or subordinated debt. This debt does not have any liens on the business. It pays higher interest rates, but typically that interest yield is not paid in cash. So that security has to essentially sit there and not get paid back while the business is ongoing. It is seated above the equity, however, below the senior debt. And when we talk about senior debt, that's everything from traditional bank debt, which tends to be more conservative, to finance companies or fincos like Monroe or others out there who are likely to put on more aggressive levels of this senior debt on top of the business capital structure.
So Matt, could you tell us a little bit about the provisions and documentation that are put in place between the lender and the borrower to ensure that that relationship remains in good standing?
Sure. So it depends on what type of debt is being put on a business. We are what's called cash flow or enterprise value lenders. Other types of lenders out there are what's known as asset-based financing. So, and I'll use that as an example first. Most banks will provide asset-based financing, and that obviously those investors are looking at and analyzing a business, but in particular, they're looking at the balance sheet and whether they're lending on receivables or inventory. That is their main underwriting tool to figure out how much debt is at an appropriate level for that business. So after close, on a monthly or certainly on a quarterly basis and usually on a monthly basis, if that was their main underwriting tool, let's say the receivables of a business, the main reporting ask that the lender makes of the borrower is to report what the receivables are. Sometimes it's even on a weekly basis so that the lender can make sure that the debt that they have outstanding is still backed up by the asset on the business that they underwrote. In our case, again, we're underwriting the cash flow of a business and ultimately what the business is worth. And so the way that we monitor that on an ongoing basis post-close, and this gets back to my mention previously about the financial controls of a business, we're going to want the company to report on a monthly basis to us all their financial statements, income statement, balance sheet, and cash flow, as well as other analysis that we'll put in place at the time of a close. And we measure ratios on an ongoing basis as far as what the ratio is of debt to EBITDA. We call that leverage. We'll look at what the free cash flow of the business is versus its debt service and other mandatory payments such as taxes. We call that fixed charge coverage. So those are the key covenants that we have a borrower report to us on a monthly or quarterly basis. Those are the standards that we generally measure the financial health of a business. Obviously, we also want the ability to speak to the management team and discuss their results and what's happening with the business, what's happening with their industry, how competitive it is, and what they see over the course of the next several quarters. But from a financial perspective, we will embed in our legal agreements that the company has to fill out certain forms with certain numbers that indicate to us the financial health of the business. And we provide cushions to those because we know that, again, not everything goes exactly according to plan all the time, but within a certain range, we want the company's financials and the ratios from those financials to fall into certain parameters.
And you make several references to the company reporting on these various metrics to the lender. How do you typically see these relationships play out? Who's interacting with who, keeping in mind the fact that this debt came into place through the use of a private equity transaction? Are you interacting directly with those operating the business? Is it the private equity folks, a combination of the two, realizing that probably every situation differs to some extent, but what could a prospective seller expect to see in this scenario?
Yeah, that's a great question. So we pride ourselves in building strong, lasting relationships, not just with referral clients such as yourself and with the private equity community, but with borrowers as well. So when we're doing our diligence before a transaction is closed, part of that process is trying to build a good relationship with the management team itself. At the end of the day, the private equity firm is not operating the business. It's the CEO and the COO and the CFO and the rest of the management team and the rest of the organization of our borrower. And so on an ongoing basis, it's very important to us to not just keep up a relationship and a dialogue with the private equity sponsor, who's obviously also an investor in the business, but with the company itself. And so we view that as a very important aspect of portfolio management going forward, because we are able to gain a lot of insights from a management team. And when we're discussing something, it's good to hear it from the horse's mouth. And if things are going well and growth's on the come and they want to raise more capital for that, that's a good conversation to have. And if things aren't going so well, we want to leverage that existing relationship with the management team to be able to figure out what the appropriate next steps are. And then lastly, I would say these relationships, the better you build them and maintain them. Healthcare finance is a finite circle, and people can be involved in various transactions with institutions. We're looking at a transaction right now, and the CFO of the company was the CFO of a different company that Monroe had an investment in. That deal went very well. The relationship was very strong at that time, and that relationship with the CFO is boding well for us right now because, and we'll get to this when we talk about the market, but it is a very competitive market, and trying to differentiate is becoming more and more difficult. And our relationship with that CFO, we think, might be the difference maker in the borrower eventually choosing Monroe as its partner.
Matt, on that point on relationships, obviously Monroe's been in the industry for a long time. I think a lot of our clients in the healthcare industry see a lot of the headline news about Chapter 11 bankruptcies and other issues that come up, and therefore have a negative connotation as it relates to debt. I guess just from your perspective, what are some of the misconceptions that you believe people might have about debt and how Monroe is different than maybe some of the other lenders out there?
Historically, in the larger market, many of those transactions were structured with the very most leverage that a company could potentially afford. And part of the thesis for paying back the debt was to be able to break up the company, sell off different pieces, and the sum of those pieces were more than the company as a whole. And some of the tactics used by the private equity firm to extract the returns were, let's say, less than friendly. I would tell you that in the middle market, which is the realm that Monroe operates in, that is not typically the tool for returns that investors take and the types of situations, frankly, that Monroe chooses to spend time in. We want to be involved in companies and situations that are growing their employment, that want to consummate add-on acquisitions, that want to expand into new geographies and may need capital to help do that. So we like being involved in what we would call good news situations, companies that are small that aspire to be medium-sized, companies that are medium-sized that aspire to be large-sized. So it is nobody's plan in the types of transactions, at least that Monroe participates in, and frankly, that most other middle market lenders like Monroe participate in. It is the hope that the business is going to grow. It's going to do well. It may be double the size that it used to be. It may employ double the amount of people that it used to employ, and that it's a good news situation. And a secondary transaction occurs and everybody gets their money back and then some. So I think that the middle market realm of leverage finance has unfortunately been a little bit tarnished by some of the headlines that you read, such as Toys R Us and some other larger scale LBOs that went sideways and involved companies that more people were familiar with. And again, transaction tactics that typically are not employed in the types of transactions that Monroe chooses to spend time in.
And Matt, so if presented with a business owner or operator that resides in the middle market, lower middle market, who maybe on a historical basis hasn't used much or if any debt to grow the business to their current size, but is now seeing interest from the private equity community, what would you say to that owner or operator about this overall investment philosophy and why the use of debt in this realm would actually be advantageous to them?
Sure. So the way I explain the types of structures that we typically get involved in, whether to a non-sponsored company or a sponsor-backed business, is you should think of someone like Monroe as providing a level of debt that is simply a little bit more aggressive than a bank would provide. So at the end of the day, although we're investing equity in certain situations, the vast majority of the capital that we're investing is senior debt. It is a situation where we are highly confident, 90-something% confident that everything is going to go great. So we don't look to over-lever a business. And again, the amount of debt that we're putting on a company typically is simply a little bit more than a bank would. And so that's why private equity firms like to work with Monroe. And that is why non-sponsored transactions are affected a lot here as well. We'll get a phone call from a CEO that says, I don't want to sell to a private equity firm yet, but I have a number of things I want to accomplish. I want to buy out a minority shareholder that has nothing to do with the business anymore. I want some growth capital to buy out one of my competitors or expand into a new geography. And I want to refinance my bank because, they just all these requirements in terms of monitoring my assets and my balance sheet. And every time I want to do something, it takes them 3 months to make up their mind. So I need a more flexible, quickly moving capital provider. Those are the situations that we'd love to get involved in because we think we can assess the risk, offer just a little bit more capital than the bank would, but make a lot of difference to the ease of use and ability to execute the plan. And so we're helping them in that regard.
That's great. And as we look to wrap up here, just curious to get your general thoughts on the debt market in terms of where it stands today, what the path has been in recent years, any thoughts on the outlook going forward and the stability?
Sure. So it is a very frothy market right now. Over the last 7 to 10 years, investors, LP investors, so I should say that the groups that are primarily providing capital to the private equity realm as well as to the private debt realm, and Monroe is a private debt investor, have increasingly seen that aggressive senior debt is a great place to operate. We provide double-digit returns to our investors, and as we talked about where we lie in the capital structure previously in this conversation, we are the lowest risk class of asset within the capital structure. So there has been a flock of capital into the middle market and lower middle market to bring rise to competitors and other players in the space, just like Monroe. In addition to that, and even a little bit of flame on that fire, is the fact that during the Great Recession, the thesis that healthcare is less cyclical of a sector of the economy than others proved out. And default rates on middle market and lower middle market healthcare deals were lower than almost any other subsector in the economy. And so not only is there been a flock of capital into the middle market, a lot of that capital has gone towards healthcare-focused lending. So we see a very competitive and frothy landscape right now. We like to think that we differentiate in a lot of different ways, but there are a lot of other people making similar arguments these days to borrowers. So we are winning more than our fair share of deals, and that's great. But it seems as though every month I read a headline about a new competitor coming into the space. Unfortunately for them, we think that a lot of the groups that don't have as much expertise as we do within healthcare and haven't seen a lot of the changes take place in healthcare over a medium or long term aren't going to last long. But in the near term, we see a lot of activity, a lot of volume, a lot of transactions out there looking for a lot of companies looking for capital. And again, a lot of capital sitting on the sidelines ready to pounce that has a mandate to put that capital out. So the economy looks strong. Interest rates are low. Our portfolio is doing very well. And so we think, at least in Monroe, we talk about the economy, we talk about our outlook for the economy and for deals over the course of the next 6 months, 12 months, 18 months. We really don't see any slowdown in the near term. So we think that this bull market, not just in the stock market, but a bull market and middle market leverage finance is going to continue for the foreseeable future.
Yeah, Matt, we echo your sentiments. We more readily see this level of appetite and interest in the market from the equity side of things, dealing with private equity groups, and it's much the same. A lot of new entrants to the market, funds being raised seemingly every single day. As you said, there are new ones coming out, and the mainstays within the market raising larger and larger funds and completing more transactions. So much the same we see on our end as well. So we appreciate the insight there, and we appreciate all the insight you provided today. Really interesting space, and I think it's terrific that we can provide some education to prospective sellers on this, what can be a complicating topic and kind of an unknown topic. So again, appreciate all your insight.
Yeah, very much appreciate the opportunity to be with you guys today. And I know you guys are very, very active in this space. So appreciate the exposure to your audience and always happy to look at any opportunities that come our way.
Terrific. Thanks again.